Hi guys, welcome to another video from Little to Simple. In the realm of business accounting, two fundamental concepts stand out as pillars upon which the financial health and success of a company are evaluated: revenue and profit. These metrics serve as vital indicators of a company's performance and are closely scrutinized by investors, analysts, and stakeholders. Revenue represents the total income generated by a business through its core operation, encompassing sales of goods, services, and other income streams. Profit, on the other hand, reflects the financial gain remaining after deducting all expenses, taxes, and other costs from revenue. Both revenue and profit play crucial roles in assessing a company's financial viability, growth prospects, and overall value. To illustrate, let's delve into real-world examples of companies and explore how revenue and profit shape their financial narratives and strategic decisions. The definitions. Revenue serves as the lifeblood of any business, providing the financial resources necessary for growth, innovation, and sustainability. It encompasses all sources of income generated by the company's primary activities, including sales of products, services, and other revenue streams. Consider Starbucks Corporation, a global leader in the coffee industry. In its fiscal year 2021, Starbucks reported a total revenue of $28.52 billion, reflecting its robust sales performance across its network of company-operated and licensed stores worldwide. Revenue from Starbucks' US company-operated stores accounted for approximately 65% of its total revenue, underscoring the significance of its core operations in driving revenue growth. Additionally, Starbucks generates revenue through various channels, including licensed stores, packaged coffee products, and partnerships with grocery chains. By diversifying its revenue streams and leveraging its brand strength, Starbucks has established itself as a powerhouse in the coffee industry, demonstrating the critical role of revenue in driving business success. While revenue provides insights into a company's top-line performance, profit represents the ultimate measure of financial success. Profit reflects the surplus income remaining after deducting all expenses, taxes, and other costs from revenue. It serves as a key indicator of operational efficiency, profitability, and shareholder value. Take Amazon.com, the world's largest online retailer, as an example. In its latest fiscal year, Amazon reported a total revenue of $386.06 billion, driven by robust sales across its e-commerce platform, cloud computing services, and other business segments. Despite its impressive revenue figures, Amazon's net profit margin stood at around 5.5%, reflecting the significant costs associated with its vast operations, investments in technology infrastructure, and aggressive expansion strategies. By prioritizing long-term growth and market dominance over short-term profitability, Amazon has reshaped industries, disrupted traditional business models, and cemented its position as a global power. The interplay between revenue and profit underscores the complex dynamics of modern business and the trade-offs involved in pursuing growth and profitability. The categories. Within the realm of profit, several distinct categories provide deeper insights into a company's financial performance and operational efficiency. These categories include gross profit, operating profit, and net profit, each calculated at different stages of the income statement. Gross profit represents the difference between total revenue and the cost of goods sold, reflecting all the profitability of a company's core business activities. Operating profit takes into account all operating expenses incurred by the business, including salaries, rent, utilities, and marketing expenses, providing insights into the company's ability to generate profits from its day-to-day operations. Net profit, often referred to as the bottom line, represents the ultimate measure of a company's profitability after accounting for all sources of income and expenses. Let us consider Walmart, a multinational retail corporation, to illustrate these concepts. In its latest financial report, Walmart reported a gross profit margin of approximately 24.6% and an operating profit margin of around 5.6%. These figures highlight Walmart's efficiency in managing its cost of goods sold and operating expenses while generating profits from its retail operations. By analyzing these categories of profit, investors and stakeholders can gain a comprehensive understanding of a company's financial performance and operational efficiency. The relationship. While revenue and profit are distinct concepts, they are inherently linked and interdependent. Revenue serves as the foundation upon which profit is built, providing the inflow of funds necessary for the business to operate. However, profit represents the ultimate goal of revenue generation, indicating the extent to which the business is able to translate its sales into sustainable financial gains. Consider Tesla, for example, a leading electric vehicle manufacturer, to illustrate this relationship. Tesla reported a revenue of $46.29 billion in its latest fiscal year, representing a significant increase from the previous year. However, despite its impressive revenue growth, Tesla's net profit margin remained relatively low at around 5.7%, highlighting the challenges of translating sales into profits in a competitive industry. Factors such as manufacturing inefficiencies, supply chain disruptions, and regulatory pressures can impact a company's profitability despite strong revenue growth. By understanding the interplay between revenue and profit, investors can assess a company's financial health, growth prospects, and long-term sustainability. The factors. The relationship between revenue and profit can vary significantly depending on various internal and external factors. For example, a software as a service company like Salesforce may prioritize revenue growth over short-term profitability by investing heavily in sales and marketing to acquire new customers and expand its market share. In its latest fiscal year, Salesforce reported a revenue of $26.18 billion with a year-over-year revenue growth rate of approximately 24%, driven by increased demand for cloud-based software solutions amid digital transformation trends. Despite its rapid revenue growth, Salesforce's net profit margin stood at around 2.4%, reflecting its strategic investments in sales and marketing, research and development, and customer acquisition. By focusing on revenue growth and market expansion, Salesforce aims to capitalize on emerging trends, gain market share, and position itself for long-term success in the competitive SaaS landscape. However, it is essential to note that prioritizing revenue growth over profitability can pose risks, such as increasing expenses, diminishing profit margins, and investor scrutiny. The strategy. Conversely, other businesses may adopt a more conservative approach, focusing on maximizing profitability even at the expense of top-line growth. For instance, Procter & Gamble, a multinational consumer goods company, reported a net profit margin of approximately 15.1% in its latest fiscal year, showcasing its focus on maximizing profitability through efficient operations and strategic cost management. Despite modest revenue growth, Procter & Gamble has maintained stable profit margins by optimizing its supply chain, controlling production costs, and investing in innovation and brand management. By prioritizing profitability and operational efficiency, Procter & Gamble aims to deliver sustainable results to shareholders, weather market uncertainties, and maintain its competitive edge in the fast-paced consumer goods industry. Ultimately, the relationship between revenue and profit is a dynamic and nuanced one, shaped by a multitude of internal and external factors. By understanding the interplay between revenue and profit and adopting a balanced approach to financial management, businesses can navigate the complexities of the modern marketplace and achieve long-term success. The examples of Apple, Starbucks, Amazon, Walmart, Tesla, Salesforce, and Procter & Gamble underscore the importance of leveraging data-driven insights to optimize revenue generation and profitability in today's competitive business landscape. Whether pursuing revenue growth, profitability, or a combination of both, companies must align their strategic objectives with market dynamics, customer needs, and shareholder expectations to thrive in an ever-evolving economic environment. See you all again in the next video, and until next time, have a good one, guys.